When you buy or sell a property, there are going to be closing costs that are due at the same time as the down payment. But what are closing costs? They are fees and charges in addition to the price of the property that are due to third-party services who assist you along the way when ownership of a property is transferred. Buyers and sellers will each have their own sets of closing costs. The costs to the buyer total between 2 and 5% of the purchase price, and the cost to the seller can total from 5 to 7%. So it's important to know where your hard-earned cash is going. Some of these costs can be negotiable, and at the end, I'll talk about how you may be able to reduce the amount of money you owe at closing. The number of different items included in the closing costs and the amounts due for each item vary based on where you live, what type of property you buy, and what type of loan you get. So how do you see or how do you find out your closing costs? Well, lenders are required by law to send you an itemized breakdown of the estimated closing costs within 3 days of when you submit your loan application. This estimate should give you a pretty good idea of what closing costs you'll have to pay, but the numbers can change throughout the process, so your lender is required to provide you with the final closing costs 3 days before your scheduled closing date. I'm going to go through a comprehensive list of all the closing costs that you might encounter, starting with the items that the buyer typically pays for. Remember that depending on where you live and your situation, you may not need some of these services. Before I dive in, if you wouldn't mind dropping this video a like, it really helps out my channel a lot. And if you want to see more investing and real estate content, please subscribe. If you're getting a loan to pay for the property, the loan application fee covers the lender's administrative costs of processing your application, and the fee amount varies from lender to lender depending on how much work needs to be done. The application fee might include the cost of your credit check. Otherwise, the credit check will be listed as a separate item. Note that there's sometimes room for negotiation on the application fee. Appraisals are necessary for lenders to determine the loan-to-value ratio for the property. The appraisal fee is paid to an independent real estate appraiser who examines the property, compares it to nearby comparable properties, and then assigns it a market value. The appraisal value needs to be equal to or greater than the purchase price in order for the lender to approve your loan, because lenders need to feel safe that they can recover their losses in the event that you stop making payments on the loan. A lot of buyers elect to have a home inspection to identify obvious issues and recommended repairs. Buyers can use findings from the home inspection report to renegotiate credits from the seller. Note that there are many more specialized inspections that buyers can have done, like inspections for lead-based paint, asbestos, and pest. Usually, your lender will require that you pay up front for 1 year's worth of homeowner's insurance before closing. Homeowner's insurance covers the property in case of damages, and the cost varies depending on where you live and if you live in a wildfire, tornado, hurricane, or flood zone. The loan origination fee covers the lender's cost of preparing and reviewing your loan documents and expect it to be around 0.5 to 1% of the loan amount. Note that the origination fee is sometimes broken down into 2 line items as a loan processing fee and an underwriting fee. Points, or loan discount points, are optional upfront interest payments at closing that reduce the interest rate on the loan, meaning that you will have a lower monthly payment. 1 point costs 1% of the loan amount. Most lenders will make you prepay any interest that will accrue between the closing date and the due date of your first mortgage payment. If you put less than a 20% down payment on a property, you'll be required to pay private mortgage insurance until you reach 20% equity in the property. Lenders require that you prepay at least 1 month of PMI at closing. Those applying for an FHA loan will be required to pay an upfront mortgage insurance premium of 1.75% of the loan amount at closing. You can decide to roll this into your loan, but you will likely end up paying more in the long run by doing so. Lenders usually want 2 to 6 months of property taxes prepaid at closing. They often keep these tax payments in an escrow account called an impound account. Courier fees cover the cost of shipping documents back and forth to facilitate the transaction if signings aren't done digitally. While not required in all states, a survey fee goes to a third-party company who measures the dimensions of the property and verifies property lines. The title company will perform a title search of public property records to analyze the deed and ownership records to ensure that the person selling the house actually owns it, and that there are no ownership disputes or liens against the property by family members, previous lenders, or contractors. Title insurance is meant to protect you and the lender in case the title company missed something during the title search and someone else makes a claim to the property after the sale has closed. Some states require an attorney to review documents at closing, so the fee will depend on how many hours the attorney works. So, try and speed them up as much as you can and avoid phone calls since lawyers love to bill you an hour for a 2-minute conversation. The closing or escrow fee goes to whoever is conducting the closing, whether that be the title company, escrow company, or as I mentioned, in some states, an attorney. Recording fees are charged by your local recording office to update the deed to the property with the new owner's information. Now we'll take a look at what the seller will have to pay for. Real estate commissions are by far the biggest expense to the seller. You can try negotiating a percentage up front with your real estate agent. There are special circumstances where you may be able to negotiate a lower commission to get a deal done, but expect to pay between 4 and 6% of the sales price, split between the buyers and seller's agents. In some states, transfer taxes are paid when the title passes from the seller to the buyer. Homeowners Association transfer fees may be due when transferring the contract to a new owner. Buyers and sellers will both have to pay a notary fee because there are a lot of documents in real estate transactions that need to be signed in the presence of a notary. Now that we've gone over all the possible closing costs, let's take a look at how we can reduce some of them. Don't only focus on the interest rate when cross-shopping, and remember to take the estimated closing costs into account. There may be room for negotiating with lenders on certain line items early on in the application process. Once you have already committed to a lender for the loan, don't expect it to be easy to go back and negotiate closing costs later. Another way to reduce closing costs is to take a lender credit. This means that you receive a cash credit towards your closing costs in exchange for a higher interest rate. This should only be considered if you don't plan on keeping the loan for very long, since your monthly payments for the life of the loan will be higher. And finally, buyers can try negotiating with the seller to see if the seller will pay for some or all of the buyer's closing costs. This only has a chance of working in a buyer's market. In conclusion, closing costs are unavoidable when purchasing real estate, but at least now you know what to expect, so there shouldn't be any surprises at closing. It's also important to understand where your money is going so that you're able to intelligently shop around, negotiate, and not feel overwhelmed by unexpected fees. So good luck on your home search, and I'll see you guys next time.